Hello investors. It's been an absolute wild month for the markets. They were off massively, then they have recovered. It's been a down month for the markets, but the good part is that our portfolio has done better. And after a few months of underperformance, to outperform the market, even falling less is a case of outperformance. And that, I think, is the silver lining and the theme I want to bring out. What we are seeing for the last few months is that due to the high inflation fear, markets have been taking a bit of a beating. It is of course being driven by high commodity prices. And the silver lining, what I say we are seeing in this month, is that there is a very good correction happening in commodities. Why we feel this will have a positive impact on our portfolio is that as commodities correct, the fear of inflation, which has an effect on bond yields, and high bond yields are never good for growth stocks, and we are growth investors. This vicious cycle could very well be reversing. And let me share with you some data points to explain what has really happened this month, why I feel much more optimistic on the markets and more so on our portfolio in the months to come, simply because there have been some very, very important developments in the market. So let me share with you first is something called the Commodity Index. The Commodity Index is also called the CRB Index, which is nothing but a summation of 19 commodities. Of course, there are 4 subsectors. And what you can see is the green line from which started from December to Jan. Commodity index almost went from 200 to 300. There was almost a 50% plus move in commodities globally. This is shown by the green line. But in the last month and a half, what you can see is the red line, which is a very sharp correction in commodities. And we feel that if commodities go below the horizontal black line, which we think is a very key support, I feel that inflation, especially commodity inflation, will be something what we'll not be speaking about. Next chart I want to really share with you is go underneath and share with you the components of what is really happening in this commodity space. The moves are massive, the breakdowns are massive. These are not being talked about in headline media or a lot of narratives, still fear and panic is, but in the underlying space a lot has changed. So first I would like to share with you the price and chart of copper. Copper is also called Dr. Copper for a reason, because it's a very big representation of industrial metals. Here also you will find in the green line, the green line is nothing but the last 6 to 7 months, and this covers that phase of the Russia-Ukraine war, which was the second very big trigger for the rise or absolute runaway in commodity prices. So you can see how copper has moved from $4 to $5 represented in the green line, but look what has happened after that. Look at the red line. Copper has fallen 27%. In fact, it has gone below the December-Jan levels. It is at 52-week lows, and this is a very, very positive sign in the overall inflationary discussion. The next chart I'll share with you are the industrial metals. These are again a very big component of industrial activity. They are very important raw materials. They in fact lead to higher prices or higher raw material prices, which get after all passed on to clients and become inflationary in nature. Here also you will notice that how the correction has been almost 42%, and industrial metals are at 52-week lows. You can see that also in stocks in Indian markets. You'll find that a lot of the metal stocks, whether it's a Tisco, Hindalco, Vedanta, everyone wanted to run to them. But you will see that the price corrections have been very sharp, sometimes even more than 50%. And that is why we have very consciously stayed away from this space. Yes, they had momentum. Yes, we felt out. Yes, people said, hey, why don't you get into this? Do a quick trade, do a quick turnaround. But we've seen that these are very cyclical and very fast. And you can see the destruction that has happened in industrial metals represented by those kind of moves that we are seeing in a lot of metal stocks. So we're happy that we stayed away. Yes, it has led to short-term underperformance, but we feel that in the larger cycle of things, where we are a larger term trend player, trying to get in and out of these trades can be very, very tricky. In fact, more often than not, they are loss-making. The next chart I want to share with you is a very, very important, very big headline, very big emotion, is the chart of wheat. We've been hearing about this Russia-Ukraine war and how this is the breadbasket of the world and how millions of tons of wheat is stuck. And this is going to lead to famine, prices are going to go up. But look what has happened at wheat. Wheat moved from $800 to $1,200 or so, represented by the green line, almost a 50% move. But wheat has already corrected 30-35%, and wheat is back at the 800 level, which it was in the pre-Russia-Ukraine war. So, this mood is bad, the sentiment is bad, the headline is bad. Everyone's been talking about wheat going up, but just nobody is covering wheat coming down. It has come down to those levels which it was pre the war. This is again very well represented by the Invesco Agriculture Fund. These are all agri things, this whole talk of famine and shortage, etc., etc. Look how this has also corrected. And we feel that trends have been broken here, and this is no longer going to be headlines. Gold, another very important asset. This is supposed to be the hedge against inflation. It is also supposed to be the currency of last resort in times of difficulties in war. Yes, gold did spike up to $2,000, and gold is back to where 1800 is. If there is so much panic in the world, if there's so much uncertainty, gold should be at much, much higher levels. So what I'm trying to share with you is that sentiment is bad, the markets are bad, but underlying a lot has changed in the last 1 month. And this we feel is very, very positive for equities as a whole. And we think that this is going to be very positive for our portfolio. And this will help us to really catch up with the underperformance that we had in the last few months, because as growth investors, we've all taken it on the chin. Let me share with you another very important chart, lumber. In the US, lumber is a very big input for housing. And everyone's been talking about this massive housing boom that is happening. But look at lumber. It went up almost 2.5 times, and it has come back. It's fallen 60%. It's come back from where it started. Natural gas, another thing, eye of the storm, energy. Natural gas is off 40%, 44% in the last month and a half. So you are seeing a massive destruction in commodity prices globally. Yes, it will get reflected with a lag in equities, and that is what makes us optimistic. If there's one chart or one commodity that still continues to worry us, is probably the most important commodity, and that is Brent crude. Crude is definitely something which, yes, has corrected, but it is not corrected as much as other commodities are. And this is something to spoil the whole thesis. If there is one area that can do it, it is this. And the thing is that I have observed over the years that Brent, unlike a lot of others, is not a demand-supply game. There's a lot of politics involved, a lot of geopolitics, a lot of Middle East politics, etc., Saudi Arabia, US relations, and I think that has been a big pain point, which has led to this kind of, frothy move in Brent. Hopefully, I feel that this is also something that should get sorted out. So fingers crossed as far as this asset class is concerned, but in case Brent goes below 100, I feel that even this will be out of the bag. This concern area will be out of the bag, and this will be very, very positive for India, because obviously, as you know, it is one of our biggest import bills and one of the eye of the storm really for global economies and for a lot of countries in and around India. The impact it is having and what matters to us is ultimately inflation and bond yields. Now on this you will see that how US 10-year bond yields had crossed 3.25 and almost hit a decadal high, a 10-year high. It's headlines. But you will notice that bond yields also have been correcting. And we feel that these are extremely overbought. We can see it in the panel below. And as I said, that if inflation does not run away, if commodities don't reverse and run away, I feel that this is something which will pause, which will cool off. And this will be positive for global equities. The next is the All Country World Index. Yes, it has been in a downward trend, but what I'm seeing in the last 3 to 4 weeks is there is a basing pattern. And finally, what matters for us is the Nifty 50. So what I really want to show you is that, as I shared earlier, we are one of those markets that's fallen the least. But the important part is that in the lower panel, we have something called the momentum index. These are overbought, oversold. And you will see that the red circle at the bottom panel coincides with the red circle in about March, April of 2020, which was the COVID lows. So markets are at record oversold levels. There's record pessimism, and we feel that the downside risk on the market is not massive. In fact, the next leg up could be a surprise on the upside. And we have gone back in history over decades and seen that in these times of panic, in times of fear, when everyone wants to wonder why they are in equities and how bad markets are doing, etc., these become times for the best risk reward ratio. Of course, if I tell you that this is a great time to deploy in equities, you may intellectually believe in it, but emotionally it is very difficult. And these for us become those inflection points which ultimately go on to give investor very good returns. So yes, things are bad. Yes, things are down for the month, but there are a lot of silver linings. And we feel that going ahead, if these play out, equities as an asset class and more so our portfolio can do a very big catch up. And with that hope, I leave you for this month. It's going to be a testing month. We also have quarterly numbers coming up. It's going to be a busy month, but rest assured, when things look really down and out, these become the best times as far as the risk reward goes for investors. Thank you very much.